All right, is everybody super excited to talk about markets? Because I know I am. But I don't think it's complete doom and gloom. And I think one thing too, like before I even start the presentation, I think the North Dakota producer. I mean, I sit in Nebraska 95% of my time. For those of you who don't know, Pat, that's our team. He's North Omaha. And, I think actually the North Dakota producer, you've been really, one, blessed with good crop yields the last couple of years, even though prices have been depressed. But you're kind of a hidden gem with some of your fixed expenses where they're at. We talk about some of the doom and gloom of the ag economy. I mean, the North Dakota market outside of just poor corn basis, there's actually still some pretty good opportunities for the North Dakota producer. But I digress, other than to say that this is going to not be super fun, but I do think there's still some glimmers of hope, and based upon Dave's observations from the price benchmarking, the opportunities that tell us to get hedged here within the next 12 months, we're definitely going to want to take advantage of it. First of all, just step through a year ago. We always try to do this. As you read these up there, some of our conclusions played out well, some did not. Obviously, we can't control weather, that ended up playing out quite drastically different than a good share of what I would call the professional meteorological ag groups were intimating at a year ago at this time. And so I think, we admittedly had the bias too. Things were set up from both a supply standpoint as well as analog year standpoint that, things could have some decent upside. Obviously, as we well know now, that wasn't how things played out. I don't need to go through all of them, but I think, we were bearish a year ago with the potential for a little weather rally, significant downside risk in the harvest. Turns out, here we are. So I don't want to dwell on that other than to say that's what we thought a year ago at this time. Dee's corn chart, and again, same deal. For the first time in many years, or the second time almost, we made our seasonal highs early in the crop year. Obviously, the acres, the carryouts, everything else wasn't conducive to giving us the rally we thought we could potentially get. But there reached a point in time where we as a group said, okay, we're past the point of no return. We still need to get this grain hedged, and still made what I would say were some decent marketing decisions, even with the options that we were given the time of the year and the lack of weather rally. That speaks to this chart. Obviously, our analytics, our market outlook, or our price signals. Obviously, had we sold all of our corn, we would have had, in February, it would have been the best decision we made. We looked at some of the May price signals, and then into early June, obviously a very dramatic sell signal on corn in late May. Although, price-wise, we were still hopeful that, there was still some talk about some late dryness. We did make some sales there. But then, as some of those forecasts rolled ahead and didn't transpire, we kept acting on stuff as we moved into late May, early June. Here we are, the USDA, as Dave alluded to. Some people don't want to believe their numbers. Things are, high or whatever. But here we are, higher yield than where we thought we were in December. And then obviously the bigger surprise was the bigger increase in harvested acres. But there's a few methodologies that people would say, well, you always got to keep it around 91.5% to 92% of planted to harvested. But there's a limit to how many tons of silage gets put up in the U.S. every year. Obviously, the Western Corn Belt had massively huge crops. If you look at the stocks and inventory number, very indicative of, hey, we filled the silage piles, we filled the alternative corn use, which is basically just that, and the rest of it went as grain. So I think that's where where we found those extra harvested acres in. We can all argue USDA should have access to RMA data, blah, 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 sooner, but regardless of that, that's kind of the justification, and you can make sense that that's why we saw the increase in harvested acres for the year. Otherwise, as we came out of the WASDE report a week ago, beans were not super shocking. Obviously, we still have some question marks as it relates to final export pace, things like that. But we will see. I don't even want to talk about wheat, but it's on there. So one thing we've done in the last year, couple folks in the audience, you know who you are, put us on to Weather 2020 group. Obviously, there's a few different of these groups that do some extended weather modeling. But they were one of the few groups a year ago at this time that said we don't, with the way we see our modeling and the way we do our methodology, we actually don't see this Western Corn Belt drought potential, much like the rest of the weather industry does. Had we listened, we probably would have made a lot of different decisions. But also, it's a game of odds, and do you put all your eggs in one basket based upon one guy or not? But we felt like, given what we've seen from their product, we actually have now subscribed to them here this late fall. I think the big takeaway from what we've seen from them is, they may not call things perfect exactly all the time, but they seem to be very good on trends. For instance, South American crop, at least as related to the first season corn and bean crop, if you looked at their forecasts, there was some extreme dryness concerns, but they had already, basically their cycle for South America restarts would have started in March of a year ago. And they basically said, this forecast is not super concerning that we see out there for at least first crop Brazilian corn and soybeans. And this was being talked about in October of last year, long before the growing season had really even begun, at least when we signed up for them. So long story short, that trend has proven true. It looks like Brazil's going to produce a monster bean crop, likely a good first season corn crop. This map that I pulled up here is actually basically the current through end of May precip percent of normal, and we do see some trends here where potentially, so if you see Brazil on the map, just south of there would be Mato Grosso, and then to the south and east, in some of the lighter shaded areas where the percentages would obviously be lower, you'd have Goiás and Mato Grosso do Sul, which are the three primary provinces that raise the safrinha crop, which is actually 70% of the Brazilian crop. I think we're all here sick and tired of hearing safrinha. That's competition for us as U.S. North American corn growers. But that crop, potentially, we see some dryness. The bean crop did get put in late. We don't have a ton of weather risk in this corn market. I don't want to, trump this up too much, but it is something that we do need to keep an eye on as we move, the Euro and the GFS forecast in the 2-week windows, especially as we move into late February, early March. It does look like things dry out in some of those areas. And we've also had a pocket down, and I don't have it on here, but we have seen some dryness in the central southern Argentine growing regions that may clip a little of that crop. Point being, something to keep an eye on here as we look at South America. Flipping over to North America, this is their interpretation of basically March 1 to July. I believe I ran this through July 31st. Basically, it's a 7-month out forecast is about all they're comfortable running on their models. As you can see, we have some areas that everything that they do is percent of normal. It's they can give you rough ideas, but so this is a percent of normal through that 30-year average normal. You can see some streaks into northern Indiana, and I know it's a little hard, but basically the lighter shaded areas would be a little bit, in that, they say 40 to 90. Most of that's actually 60 to 70% of normal. 2 areas that are well above that. Obviously, looks like North Dakota. We've got we have the potential for some above average precip. I got another slide here that lays into that a little more. Looks like where I'm at in Nebraska, Looks like we're probably gonna be running some pivots this summer to keep things rolling along. But overall, if you look at this forecast and even using some other folks' the other modelers out there, kind of similar agreement that we don't see a major weather thing coming, that or setup that we would see either using their methodology or conventional. North Dakota, this was more of a slide I wanted to bring up just so guys maybe need to mentally prepare a little bit. If you look at, again, this is a March 1 through July 31st forecast, and then at the bottom you can see the percent of averages based upon the week of the year. What probably concerns us the most is as you get into late April, into early May, their cycle methodology indicates that it doesn't mean it's going to be a 200% of normal precip, but other than to say we have a spike in precip potential in that late April to early May period. I don't have it on here, but also combined with some pretty cold temps. So we'll see how this plays out, but it looks like we could have potential for delayed plantings, maybe some PEP in certain areas. Obviously, southwest North Dakota looks extremely wet. Pockets elsewhere that are wet as well. It looks like the folks in the southeast are around 100% of normal. So, that being said, it hopefully is a little more normal in those part of the areas, the north central part of the state. But for those of you in definitely the darker green areas, it looks like as soon as conditions are good in late March, early April, for whatever field work you want to get ahead on, it may be prudent to get things prepped and ready to go, because we may be looking at another last half May, early June planting window in North Dakota this year. Just one other, again, this is an IRI. We had similar slides a year ago. Obviously, it was way drier. That it proved not, but I just wanted to throw this one in here. May, June, July, just issued here in January. Again, doesn't look very concerning from a precip perspective as we move into the critical growth windows for our row crops here in the United States. So let's talk corn first. Obviously, with bigger acres, bigger yields, higher stocks to use. 13.6 as we come out of January, obviously that was almost over a full percentage higher than where our December stocks to use ratio was. Obviously, we have some question marks about even the demand pieces. Are they even real as it relates to feed and residual? TBD, but that's what the numbers that we're given today. This is burdensome. I mean, you can look back through history. This is not a stocks to use number that's indicative of massively higher prices during the growing season. Similarly, rolled corn balance sheet, obviously not at record highs, but definitely a lot different than where we have been and continues to grow. We'll see here, but we aren't. U.S. is continuing to add to this carryout number. Probably the biggest indicator is, and we don't have the percentages, but this is all years that corn stocks to use as of January 1 were higher than 13%. And then percentage rally basically from that Jan 1st price to when those higher prices occurred. As you can see, 17% was a high side, 8% was a low side in the year that it occurred in. Bigger takeaway in all of this is if you get the max or the min, you're given where our stocks to use ratios are at here, and the chart lays it out pretty well here, we're just probably trending down, potentially still have our seasonal weather rally, but combined with hopefully our analytics performing as they have, when the opportunity arises sometime here between now and likely end of July, that we'll have an opportunity, and when we do, we probably need to act on it quite heavily, just because the stocks to use number is going to be very burdensome as we continue to move through this crop year. World major corn exporters, as you can see too, everybody that raises corn and sends it out to the world their numbers are growing as well from our lows in 2021. So again, nothing super friendly here other than just this is all in the backdrop of, as we talk to you guys as farm clients, like the chances of us having, I mean, there's always an outside percentage chance of anything, but an explosive rally to $5.50 or $6 is so on the outer bounds of potential for this year that, you know, the $4.70 to $5 new crop, even that could be a challenge. But if we get into those ranges here on a weather rally, that again probably levels we need to act on quite heavily. The fund spec, obviously, they can be our good friend, they can be our best friend, and they can be our worst friend, depending on how they want to be positioned in the marketplace. As of last CFTC report last week, they had sold quite a few contracts coming out of the WASD a week ago. They have a small short. We'll see if they want to keep building on it. It looks like, at least for the interim, we've created we kind of traded our low here on March corn. We probably just grind sideways, and I think until we get through the better part of the growing season, I would guess the spec money is going to just kind of hang out here, slightly neutral, maybe slightly bearish on their overall fund view. Probably as we extrapolate into this next year, this is the thing that's concerning as we obviously go through all of our projections and our break evens for this next year. You got your 25, 26, January, those are our final numbers, the 2.23 billion bushels down at the bottom, the 13.64 stocks to use ratio. And then you throw that number, here's some ideas on where, this is using 180 million principal corn bean acres for the next year. So if your low estimate on corn would be your high estimate on beans and vice versa when we go to the beans slide sheet. But basically, as you can see here, 186, probably trend yield, 94, 97 million acres. We'll kind of have to see. We're definitely probably not shrinking this balance sheet at all. And if we end up with big corn acres again and trend yield, we need to find more demand, and we're kind of tapped out there right now. So this is concerning. This is, again, another thing to say. We get this weather opportunity, marketing opportunity sometime in the next few months. We definitely want to lay into it. I think a lot of you have we've been doing some range double up contracts from next March and stuff like that. Again, selling the carry, selling option time value on the curve still creates some value for us even at these levels on the front end that don't look as attractive. So it's important that we, especially if we're going to be upping our corn acres, upping our bean acres, upping our canola acres in lieu of less wheat or something, we want to make sure that we're getting some of that grain hedged out in the curve here. One bright spot, we have yet to see it. There was actually a unknown sold in U.S. corn this morning. Probably not China, but one thing to keep an eye on is basis price. Chinese domestic corn prices are at a pretty large spread to U.S. Domestic corn prices, to the extent that, there's been some arguments that although China supposedly had a record corn crop, there's some concerns about quality, as well as, was that corn crop as big as we thought? So all I want to bring up this slide is, if we do start seeing, the Chinese show up, it's not in here, but there was a slide this morning, Chinese, if you look at Chinese corn imports, since basically the mid-2000s, we had, a big spike from 2021, as we all remember, as we went through that year as they rebuilt stocks. We haven't seen hardly any corn export import in 24, but actually have started to see a little bit of an increase here in 25, which tells us that they see some value in these price levels. Something's obviously going on domestically. It's all been Brazilian corn to this point, but the broader point is at least there's a big dog in the world marketplace buying corn. So even if we aren't directly the beneficiaries of that Chinese purchase, it's taking more corn inventory out of the world market, therefore at least supporting U.S. export pace where we're at today. Soy balance sheet, obviously wasn't and still isn't super bearish. I mean, stocks to use has grown, obviously mostly based upon our issues with trade surrounded, the Chinese, exports and Chinese buying. They've now fulfilled their 12 million metric ton commitment. Should be on pace, barring something else crazy going on the trade front, that they're in for 26 million metric ton, which would be their more traditional export numbers as we move into what we would call this next crop year. So if that happens, that'd be a good thing. World soy balance sheet, same deal. We're just kind of chugging along here. We haven't shown a lot of growth. This is including even what we would call a massive Brazilian bean number in this stocks to use number. So we think, given what prices have done, we priced in this big South American crop. We're working back to what do we need to do, and we'll see it here in a second as we look at projecting carryouts. Soy corn ratio, we're back up to levels that, this is a new crop, no versus new crop D's corn. Obviously, it spiked some, corn's fallen off, beans have held steady-ish. 236 doesn't get guys to switch a lot, although I think, and I'll allude this in some conclusion sides, we had a lot less prepay corn and bean seed done this year, a lot less fertilizer committed. So I think there still are quite a few acres across, especially the Central Corn Belt, that there's a question mark of, where we're at. I know in Nebraska, especially northeastern Nebraska, more dry land, we were very heavily weighted to corn a year ago. Some of those acres naturally are going to come back as beans, and I think that's across the whole Corn Belt. You're seeing that to some extent. So we'll see here, and I'll show you the balance sheet here. Same thing, 817 carryout. So if you think about where we were at on the corn side, and we take our mid-range on the corn acres, or on the bean acres here, average yields around 53 now, trend. It actually does not look, that painful on bean acres, even if we get up to an 85, potentially even higher planned bean acres number here. So this is encouraging. Obviously, I know the North Dakota producer, we were all heavy corn, looking at other opportunities. Nobody wants to plant wheat. We don't want to ruin it for ourselves completely, but it does look like at least we have a glimmer of hope here on the bean balance sheet to find some better values. You get a late season weather scare on beans, even if it doesn't end up being much. $11+ new crop beans still feel like we should have a shot at those. Obviously, if we're at the low end, we'd be closer to 12. I probably should just skip these next slides because I don't think anybody wants to think about this, but the broad takeaway on spring wheat is it's not fun, both from a U.S., North Dakota, obviously driving a lion's share of the spring wheat. We're edging up towards near record carryout stocks to use levels, even though we continue. I mean, I can think about guys I've worked with now for almost 8-9 years, and when I started working them, we were a third, and a third, corn, wheat, beans, and they don't have an acre of wheat on the farm in the last 2 years. So the farmers responded, but we still somehow keep raising spring wheat and still keep adding it to our balance sheet. Biggest issue being the world has continued to raise exceptionally good wheat crops the last 2 years, which has not helped our carryout at all. World wheat balance sheet again speaks to this. We just keep creeping up our stocks to use numbers. Production just, on that white line just keeps edging ever higher. That's where we stand. This is again weather 2020. This is a March, I believe through, I think June 30th I ran this number. Long story short, this also flows over onto the Russian side, although their maps don't look as nice, so I didn't put it in here. But basically, again, not seeing a major issue, maybe excessively wet could be made, a case could be made at some point, but it does not look like we're going to drought out the breadbasket of Ukraine and southern Russia this next year. World wheat major exporters, this obviously, much like the corn side, this is, this 18% that we see coming out of this Jan crop report, again, very burdensome. I mean, nearing levels that we saw in 09-10, nearing record levels here. A lot of wheat in the world marketplace that needs to go somewhere. We need a weather event somewhere, a production problem to start curing some of this. World wheat demand itself hasn't changed. The only concern here would be is if you get feed wheat cheap enough in the world that then that actually starts impacting our corn export markets. Time will tell, but again, biggest takeaway here is just burdensome stocks. Doesn't look like we're gonna have a major weather event likely in the Northern Hemisphere wheat crop, at least as we know today. This number probably continues to get larger. Ironically, these are the same headline risks I think I put on the slides a year ago at this time. I maybe re-ranked them a bit. We're still talking about 45Z credits. That is in front of the Office of Management and Budget now. They think could be a ruling on it sometime February, March, but we literally were talking about this a year ago, February, March. So the government at their best. It may not even be, I mean, it'll be impactful in the sense that it would consolidate all the things that we've geared up for in the biofuels, the bean oil markets, hopefully is impactful to usage, which therefore would be a good thing as we get into basis and stuff. But it's not going to be, we get an announcement on it, doesn't mean we're going to be limited up on beans for 16 days in a row because of it. Still have world hotspots. I mean, I probably could just take Ukraine off of this because we can blow up wheat ships, we can hit ports, we can threaten nuclear war, and apparently that does not affect wheat price at all. So whatever that may be, that continues to grind out. Maybe a conclusion of the conflict there would be, bullish wheat prices for all we know. Everything's been bearish when it should have been bullish. So maybe it's an opposite. Taiwan's still on the radar, obviously. Middle East, we throw in Venezuela and Greenland. Your guess is as good as mine, but certainly the market is almost, I wouldn't say become immune, but things that we have construed as very bullish or bearish in years past has almost been a moot reaction as it relates to commodity markets, oil, grains, et cetera. Probably what I see coming down, we don't know these tariff tweets. We obviously know everything gets tweeted and then things get rolled back. Things aren't as bad as they seem. That being what it is. But Powell's out in May. The Trump administration has made it very clear that they want a much friendlier Fed chairman, and a Fed chairman determines interest rates. And I believe the top two contenders for the new Fed chair position have already, publicly stated that they believe interest rates should be lower than they are. We see interest rates, given the amount of debt we have, you can do all the pieces of the puzzle that you want to tie all that together, but basically we drop U.S. Federal Fed rates. Likely you're going to start seeing dollars starting to bleed out and start seeking some higher returns. Commodities being kind of the dog the last year and a half, that we potentially could see some money flow back in corn, beans, especially if we would get a bit of a weather move. It wouldn't take much for those dollars to find an inflation story there too. Conclusions. Like I said, corn economics, we're still favorable up here. I mean, especially if we keep maintaining the yield structures we have. It's still not a ton of fun, but it's still better than bleeding out at $200 negative equity an acre on stuff. North Dakota corn stocks, as Dave alluded to in the overview slide, continue to be very burdensome. We need more demand locally. We definitely don't want a P&W corn program to shut down. I think the biggest takeaway as it relates to the producer group in here, as you look at the rest of your balance of your marketings, we don't see huge, some years we're like, hey, we should be carrying more corn into the summer because we see this massive basis potential, whatever. we see basis being fairly flat from now through midsummer. So I think if you want to move grain, as long as we can justify the spreads and everything, continue to just keep chipping away at this corn crop, because there's obviously going to be somebody that's going to be sitting with bins full come October 1st of this next year, and gets very expensive to carry this crop. We'd rather turn it into cash and figure out what we can do with it later on. Mentioned before, corn seed fertilizer prepays, talking to multiple guys in various areas. We're well behind, so I think that does leave some questions on, especially central, true corn belt acres, where we're going to be at. Again, reiterating some of the things we talked about in beans here. Big crop. We think we've priced in a lot of this big South American crop. Normalized Chinese relation. Hopefully we're not having to put a bunch of beans in the bin this next fall. If we can trade this nominal 60 to 80 under new crop bean basis this fall, we can haul stuff in off the combine. That would be a breath of fresh air, that not having to bin our massive bean crop and then a massive corn crop right behind it. Well, some areas of good crops here on beans in North Dakota this last year. We do think that for those that want to carry some beans, although they're expensive to carry in the bin, we do see some fairly explosive bean basis. I think the heart of the freeze, frost, poor yield was localized, especially around this, both the green bison and then the North Dakota soybean plant at Castleton. So we think there's a pretty good chance that you're going to see some pretty explosive bean basis potential. I'm not talking like $2 over or anything, but I think we could nominally trade 0 to small unders at some point this spring and summer, especially if we maintain, sub $11 board. Farmer gets disengaged as he starts to move to the field. We have, excessive rains, guys can't get stuff moved. So if you are carrying some beans in the bin, I think at least as your tributary to those markets in the central and south part of the state, you will find some decent values. Wheat. That's all I got to say about that. I think the biggest thing we want to talk about on wheat and the biggest takeaway is there's opportunities to sell some wheat out in the curve next March. We've, I think, talked to a lot of you guys that are raising wheat for this next year. $6.50 doesn't look like a lot of fun today. We're close to that. If we can get some of those targets to hit, it's probably some $6 wheat. It's not fun, but certainly less painful than $5.60 nearby wheat as we stand today. I only put this conclusion slide so then I can copy it for next year when I do the what we thought a year ago at this time. Nothing new here other than just kind of stating what we're seeing today. And, I think the broader thing in all of this, and this should be the takeaway, and I think we tried to tell the guys, is with the change in corn carryouts coming out of this WASDE, everything's going to be burdensome. Anything that we get a shot at a rally on, much to the benchmarking thing, we need to act against our signals, be fairly aggressive hedgers, and just get through, make some dollars, and just not bleed equity for another year. Questions? Hopefully that wasn't super depressing, but I think we got to live in the reality of what it is and not be angry about numbers, as Dave said, and act on the things that we need to. And like I said, you as a North Dakota producer, northern fringe, call it Corn Belt producer, you still are advantaged. Even though you look at crappy basis and everything else, there is still opportunities that the central, heart of the Corn Belt guy, it's going to take me over $1,000 an acre to raise an acre irrigated corn next year in Nebraska. So my threshold on I need 250, 260 corn to kind of make the math work. And, you guys up here, if you can raise 180 plus bushel central North Dakota corn, you're making actually decent money. So you kind of do live in a little blessed part of the world. Hopefully the expenses keep staying low, but that's kind of where things are at. Questions at all?
We better move on here.
Yep.
Thanks, Andrew, and plenty of time to chat one-on-one